The United States just made a bold move. It told JP Morgan and Bank of America to back out of a Chinese IPO, not in New York, but in Hong Kong. And how did China respond? No speeches, no press events, just silence. Then, all of a sudden, a quiet withdrawal. Billions of dollars in U.S. debt sold off without warning. No media buzz, no photo ops, just a cold, calculated exit. But this isn't about one IPO. This is bigger, much bigger. This isn't a trade fight. It's not a diplomatic freeze. It's a slow, deliberate breakdown of the global financial system, one deal at a time. So where's all that money going? According to Bloomberg, a growing share of Chinese capital is shifting into non-dollar assets, things like gold, BRICS, infrastructure bonds, and Yuan-denominated debt. In fact, physical gold purchases by Chinese institutions have skyrocketed. The Shanghai Gold Exchange hit a 5-year volume record in March. Meanwhile, China is doubling down on building regional ties, investing heavily in new trade corridors, and lending systems that prioritize local currencies instead of the dollar. It's not just about what China is buying, it's also about what it's building, a financial system designed to work independently of the dollar-driven global order. One surprising move? Chinese investors have significantly boosted their holdings of Japanese government bonds. In the first quarter of 2025, holdings of Japan's 10-year bonds jumped 28%. Why Japan? Because it offers liquidity, stability, and a non-dollar alternative that still acts as a hedge. The bottom line? China isn't backing down. It's stepping aside, quietly leaving one system while assembling another. These moves may not be making front-page news, but they're definitely shaking Wall Street. And the impact is already being felt. As foreign demand for U.S. Treasuries drops, the U.S. government faces a new problem: higher borrowing costs. If China keeps cutting its holdings, interest rates could rise, not due to inflation, but because its biggest foreign creditor isn't showing up at Treasury auctions anymore. That ripple effect is serious. Higher yields mean more expensive debt for the U.S., tighter federal budgets, and more pressure on the dollar's status as the world's reserve currency. As confidence slips, even U.S. debt, the so-called safest investment, starts to feel a lot less secure. What's unfolding is a slow, cold decoupling, not with press conferences or sanctions, but through numbers, trade flows, and financial strategies. China doesn't want to crash the current system. It's building a new one. And this time, Washington isn't at the center. And China isn't alone. Other nations are watching, taking notes, and in some cases following suit. As China steadily pulls back, the U.S. is preparing to respond, this time not with tariffs, but with bold legislative moves that could push U.S. capital out of Chinese markets altogether. In April 2025, the Senate Banking Committee advanced a rare bipartisan bill with a clear message-cut financial ties with China's core industries. The bill targets over 220 Chinese firms deemed strategically sensitive, spanning defense, biotech, artificial intelligence, and telecommunications. But the focus isn't just national security. It's about controlling the flow of investment. Bloomberg Intelligence estimates that these companies are linked to around $812 billion in U.S. connected capital. That includes money from index funds, pension plans, private equity, and American depository receipts, ADRs, which allow U.S. investors to own shares in foreign companies. If the bill passes, major American investors would be forced to exit within 12 months. That includes firms like BlackRock and Goldman Sachs, who would need to quickly unwind billions in Chinese assets. And the consequences? Huge. BlackRock alone manages $115 billion in Chinese holdings that could be affected. The biggest hit would be to passive funds, especially ETFs that track emerging markets. These funds aren't meant to make political moves, but under this bill, politics would override investment strategy. Experts are warning of a domino effect. Forced exits could trigger major price swings across both U.S. and Asian markets. Liquidity would disappear. Valuations would crash. Wall Street's presence in Asia's $34 trillion market could shrink, almost overnight. We're already seeing the early signs. Some Chinese firms listed on the New York Stock Exchange and NASDAQ are starting to consider delisting, not by choice, but because the legal risks are becoming too high. And behind all of this is a bigger question. Can U.S. capital stay competitive in a world where it's boxed in by geopolitical red lines? America's financial system was once known for its openness, its flexibility, and its neutrality, but now those strengths are being traded in for control. And this time, the effects won't just touch a few IPOs or quarterly earnings reports. They could reshape the role of Wall Street on the global stage. For good. In the East, things are moving fast. While Washington tries to cut the power, Asia is already wiring up a whole new system, and the balance is shifting quickly. As the U.S. ramps up financial pressure, Beijing is quietly working on something much bigger, a full-scale financial system that doesn't rely on Wall Street at all. In early 2025, China's Central Financial Commission pledged $423 billion to strengthen its own financial foundation. This investment covers a wide range, from bond underwriting to cross-border settlement systems, and even fintech platforms designed to compete with Western clearinghouses. The mission is simple: reduce dependence on U.S.-dominated systems and let Chinese money move freely without running into dollar roadblocks. One of the most significant changes underway is China's plan to stop relying on Western credit rating firms. By 2026, Chinese regulators plan to fully remove Moody's, Fitch, and S&P from their bond markets. In their place, new domestic rating agencies, under the guidance of the China Securities Regulatory Commission, will set their own rules and standards for evaluating credit. And this push is already seeing results. Just in the first 3 months of 2025, the Shanghai International Board, China's version of the Nasdaq, saw $112 billion in fresh foreign listings. Companies weren't just Chinese, they came from Southeast Asia and the Middle East too. These are businesses that would have listed in New York in the past, but now they're choosing Shanghai. It's not just about the systems, it's about trust. China is offering companies in emerging markets something the U.S. can't access without political strings. No fear of sanctions, no sudden delistings, just capital, with fewer risks. While America tries to freeze the old system, China is quietly building a brand new one, and more countries are signing up each day. As Washington tightens financial pressure, the world is already shifting its bets. At the heart of this transformation is BRICS, not just as a political club anymore, but as a serious financial alternative. In the first quarter of 2025 alone, the BRICS interbank payment system processed $56.44 billion in cross-border payments, a 320% jump from the same time in 2023. That's not just symbolic. It's a real shift away from SWIFT and dollar dependence. China is leading the charge, providing more than 65% of the Yuan needed for BRICS settlements. And others are quickly following. In April, Saudi Arabia issued a $4 billion bond, entirely in Yuan. The bond was oversubscribed 4 times, with eager buyers from India, Brazil, and Egypt. The message was clear: raising money no longer requires the U.S. dollar. At the same time, data from the IMF showed the dollar's share of global foreign exchange reserves had dropped to 57.4%, the lowest it's been in nearly 3 decades. While the dollar is still on top, its decline is no longer slow. It's part of a larger shift. The signal to emerging economies is strong. You no longer need Wall Street to raise funds or float sovereign bonds. This isn't just about diversity. It's about survival. Countries are preparing escape routes before the next wave of U.S. sanctions rolls in. And every bond priced in Yuan, every BRICS payment that skips SWIFT, asks the same question louder and louder. Is the U.S. dollar still the global default, or just one option among many? Wall Street thought it had time. But today it's not about how big you are, it's about how fast you move. While Washington debates, China is building. U.S. banks retreat and BRICS banks take their place. One IPO here, one Treasury deal there, one more bond sealed in Yuan. This isn't just background noise, it's a quiet financial revolution, carried out through capital, not conflict. So here's the big question. Is the world still following America's financial lead, or is it already heading out the door? Let us know what you think in the comments. And if you found this breakdown useful, don't forget to like and subscribe for the next deep dive. See you in the next one.